Today, new housing loans are up, but just how much? Hello again, it's Martin North from Digital Finance Analytics, writing the latest post covering finance and problem news with a distinctively Australian flavour. The ABS has released the latest statistics relating to loan flows for credit in Australia. Now, this is the series that they've been adjusting and changing in recent times, thanks to new underlying data. But nevertheless, we're now getting quite a good picture as to what's really going on. And they said that the value of new loan commitments for housing rose 1.8% in November, and that's seasonally adjusted according to the latest ABS figures. And the chief economist is quoted as saying growth in the value of new home commitments for housing continues to be underpinned by owner-occupiers, with the value of new loan commitments for owner-occupied housing rising 1.6% in November to record the sixth straight month of growth. And the value of new loan commitments for investor housing also rose in November, up 2.2%. However, over the longer term, this series remains down on recent peaks in activity. The number of loan commitments to owner-occupied first-time buyers fell 0.9% in November, following a 0.4% fall in October. And this was the first back-to-back fall since January 2019. And owner-occupied first-home buyers accounted for 29.7% of new housing loan commitments for owner-occupiers in November. And by the way, the value of personal finance fixed-term loans fell 1.4% in November, following a 2.2% rise in October. But this really doesn't tell you too much about what's really going on. So what I want to try and do is to build a narrative based on some more detailed analysis that I've done. And it's all to do with whether the seasonally adjusted numbers can be trusted. The reason I have an issue with it is because the seasonality is really weird this year, thanks to all the changes in lending standards, the election and other things. And therefore, I have doubts about the accuracy of the seasonally adjusted data. So as normal, I'm going to continue to go to the trend data, which is designed by the ABS to iron out all of the lumps and bumps that might be in the seasonally adjusted numbers. And the trend data tells a rather different story. So to take the discussion forward, I want to start with the annual credit aggregates from the Reserve Bank to November 2019. These are the figures that came out just before Christmas, and which I did a post on earlier. And just to remind you, total housing growth over 12 months has dropped to an absolute low of 2.9%. That's the lowest it's been for as long as we can remember. Within that, owner-occupied housing rose 4.7%. So from a loan balance perspective, it's owner-occupied housing that's really still ahead, compared with investment lending, which went backwards again, down 0.3% over the last 12 months. Personal credit continues to fall, whereas business credit is still growing, but at a lower rate of 2.5% over 12 months annualised. So that's the backcloth. Now let's look at the loan flow data. So this is the data relating to new loans and refinance loans over the last month. And this is data to November 2019. So they show that the net loan flows in November was still growing, but the rate of growth has dropped back to 2%. It was higher a couple of months ago. Investment lending is also still growing, but at a much slower rate. And lending to first-time buyers is also consistently down over the last couple of months. And the growth rate there is just over 2%, but considerably below where it was. So if you look over the year, you can see that there was definitely a spike post the election, but the rate of growth is now easing back. Now, you can also look at the same over a slightly longer period, over 3 months, because some would argue that just taking a monthly view doesn't necessarily give you the full picture. So here is the 3 monthly view, and there, again, you can see the rate of growth for owner-occupied lending is easing back, as is the rate of growth for investment lending, and the rate of growth for first-time buyers. So this is definitely a consistent trend that we're seeing. In other words, lending is not accelerating, the rate of growth is deaccelerating at the moment, although it's still in positive territory, whereas last year, of course, it was in negative territory. Now let's look in more detail at the owner-occupier monthly trends, again to November. And we first look at lending for new construction. And that is continuing to die. It's down another 1%. So less people are borrowing to support the construction of new buildings. And that is a consistent pattern that we've seen now for well over a year. Whereas borrowing to purchase existing properties for owner occupation is definitely still rising, but the rate of growth has fallen back from a peak of over 3% a couple of months ago back to close to 2% and is continuing to fall. And refinancing, which did hit a bit of a peak in July, and that was to do with the rate cuts, is now falling back to pretty much zero. And that's because more people think that rates will be cut again soon, and therefore they don't want to lock themselves into a fixed rate when there might be a better, lower rate available on a variable loan just down the track. Now we can look across the states as well. And I can warn you now, this chart's going to get a bit messy because, of course, we have to look at each state, but the main ones come first, so it shouldn't be too bad. New South Wales, you can see there that the rate of growth for owner-occupied loans in New South Wales has dropped from 4% and is now heading towards 2%. Victoria is following a similar path, although it only got to 3% growth. Queensland, which was just over 2%, is now touching 2%. And South Australia, which did peak around 2%, is now below that. And Western Australia is down, having got close to 2% a few months ago, and is continuing to ease back. Tasmania had a significant peak earlier in the year, but is now in negative territory, so the volume of loans there is actually going backwards in terms of new loans. Whereas in the NT, the trends are much less easy to see because the volumes are so low, and we saw a considerable drop a few months ago, but it's still in negative territory now. Whereas the ACT, another very small volume, peaked close to 4% a couple of months ago and has eased back. So let's now look at trend investment loans to November 2019. And here we look at first new investment loans. So these are for all investment purposes, and the growth there was close to 2% back in July, and it's slid back now down to 1%. Property investing for refinance purposes, which was close to 4% a few months ago, has now slid back below 2%, and that's again because interest rates are likely to go lower, and there was a spate of refinancing which occurred around the last rate cuts. You might see that re-emerging if in fact the Reserve Bank does cut rates again, let's say in February. Now let's look again across the states. In New South Wales, you can see that there is some growth still, but the rate of growth is easing back. The same in Victoria. Victorian growth was quite a lot stronger. It was above 2%, and now it's fallen back. Queensland, a bit the same, falling back close to 1%. South Australia is in negative territory. Western Australia is still in positive territory, but easing back towards zero. Tasmania, a bit the same. Whereas in the Northern Territories, there's a bit of a spike, but the volumes are very low. And in the ACT, there was a spike earlier in the year, and it's now falling back, although still in positive territory. So now let's look at first-time buyer loans to November 2019. So first, we'll look at the value of loans written. And this is reading off the right-hand scale. So you can see that just over $3.5 billion of loans were written in the month. And that's a peak. Now, if you look at the number of loans written, you can see that they are sitting at around 9,000 a month. And that is quite high. We hit a similar number back in September 2017, and prior to that, it was quite a lot lower. We'll come back to those two figures after we've looked at the states, because there's quite an important issue which I want to highlight shortly. But first, let's look at it across the states. So Australia-wide, you can see that the growth in terms of first-time buyer new loans is tending towards zero. In New South Wales, it's actually gone backwards, so it's below zero, whereas in Victoria, the rate of growth is still positive. In Queensland, it's close to zero. In South Australia, it's up just a little above zero, but hardly noticeable really. In Western Australia, it's below zero. In Tasmania, we're now below zero. The rate of growth in the Northern Territories is well below zero, but again, it's very volatile because we have very small numbers. And in the ACT, it's still positive, although nowhere near as positive as it was a few months ago. Now let me come back to the point about the relationship between the number of loans and the value of first-time buyer loans. This is a very important point. The average first home buyer loan is now at a record high of $408,008. It's never been that high ever. And what that tells us is that first-time buyers who are coming into the market are getting bigger than loans than ever. And that might tell us something about the looser lending standards that are now in operation. And to bring that into contrast, the right-hand scale here is the average in growth of loans from month to month. And in fact, in the last 6 months, the average loan for first-time buyers have risen by more than 7.5%. And that is a pure reflection of the looser lending standards that APRA and the banks have implemented. Now, my concern is that most first-time buyers are not seeing any real income growth, and yet they're being allured into the market and being offered bigger loans than ever before. And that's before the new government-backed deposit scheme comes into force properly. Of course, CBA and NAB are now starting to lend. Others will follow later. So this suggests to me that it is the first-time buyers who are being lured into the market, and that's consistent with our recent report where we looked specifically at who was likely to buy. First-time buyers were very much to the fore. The question I have is whether this is sensible given the current economic climate that we're in and given the fact that incomes are not rising and the costs of living are, and of course mortgage stress is continuing to grow. So to conclude, I think the loan growth data this month really rings some alarm bells for me. Firstly, first-time buyers are being offered bigger loans. Secondly, the rate of credit growth is easing back, which is actually a good thing given the flat incomes and rising costs. But third, I expect to see yet more initiatives to try and encourage more people to borrow. On the other hand, the gross data from the RBA shows that lending is still going backwards because more households are paying off debt. I think that's very sensible. And that means that lenders are going to remain under pressure for some time ahead. Before I go, just a quick reminder, next Tuesday, 21st of January at 8 p.m. Sydney time, we're going to be running our next live stream event. You're welcome to join us and ask a question live via the chat or send in a question beforehand via the DFA blog. The links are in the comments below. Mark your diaries and I look forward to seeing you there next Tuesday. I'm Martin North from Digital Finance Analytics. Many thanks for watching and I'll see you again next time.